and the increase was 2.4 times. The key is to look at the long series data over at least 10 years on an average, and when you do that, it clearly tells you that on an average real estate will give you return of around, if in a market like Bombay which has done so well, the 10-year return is roughly 9%, or essentially your investment becomes 2.5 times what you invested over 10 years. Nothing spectacular, not bad, but nothing spectacular. In fact, if you look at each of the 10 years and compare the returns from say Sensex and a particular locality, say Colaba and gold, then if you look at 1990 to 2000, Sensex gave the best return of 21.24%. 91 to 2000, again Sensex gave it at 14.75, Colaba 12.22, gold was, and please remember, for both Colaba and gold, these are gross returns. They are not net returns. Here, these are, because it is tax free, this is both pre-tax as well as post-tax. From 92 to 2002, real estate did much better. 93 to 2003 again. 94 to 2004 again real estate did better, but barely over Sensex. 95 to 2005 again it did better, but barely over Sensex. And then the Sensex came onto its own. 96, 97, 98, for 10 years it gave better returns. Before gold in 2009 and 10, it took off and therefore gave super returns even over 10 years. 2001 to 11, again Sensex gave a better return. 2002 to 2012 it was again gold, and 2003 to 13 it is back to the Sensex. So if you look at this 23-year period, and there will be 13 10-year periods in this, only 4 times has real estate beaten has been the best investment, and that too on a pre-tax basis. And gold has been a best investment for 3 times, but Sensex has been a best investment for 6 times. If you look at the minimum return over these 23 years or 10 years, I think gold has done better at 4% roughly versus 3% for Sensex and 2% for Colaba. Maximum return again, Sensex has been much better at 21% versus 20% for gold and 14% for Colaba. And average return wise, again, the Sensex has always been better. So all the 3 asset classes have, for over a 10-year period, have been at least positive. They haven't given any capital loss. But if you look at either the maximum or the averages, very, very clearly the Sensex scores way above both gold as well as, in this particular case, Colaba, but you can replace this with anything and it will still remain the same. Any questions so far, or anything that I can answer? There is a question here. I think the question here is, my building friend bought a flat in Charco for Kandivali in 2002 for 12 lakhs, which was sold for 62 lakhs in 2012. Okay, so this is a question. Okay, so I think we will look back at this. 2002 to 2012, it became roughly 5 times. Net of tax probably slightly less than 5 times, but let us say 12 lakhs became 60 lakhs net of tax in 10 years time. So what is the return? I think that is the key. Okay. So we will find that out. We will talk about it before we end the webinar. Any other questions? Anybody else has any other questions? I can unmute you. Please raise your hand. and I can unmute you if anybody has any questions. Okay, in which case, let us proceed. Let's turn to that example that we took the first time. Tanya had raised that what is the return in the example. You remember she had given us this example, 99,000 became 16 lakhs in 20 years. A 16 times growth in 20 years time. What is the return? Let me put a poll to everybody. What is the return? Is it around 15%? Is it greater than 15% but less than 20% or greater than 20%? Please vote. I request your votes. I'm waiting another 10 seconds to go. Okay, I'm going to now close the poll. I think 60% feel it is around 15%, 40% feel that it is greater than 15% but less than 20%, and nobody feels that it is greater than 20%. Well, I think in this case the audience poll is correct. The real answer is that it is around, it's slightly less than 15%. I think net of tax it will drop to about 14.5. What is interesting is what would have happened to the same amount had it been invested in the Sensex at the same time. If 99,000 rupees had been invested in the Sensex in 1981, what it would have become in 2001. Would somebody like to take a guess? Please raise your hand if you would like to take a guess. It would have become 26 lakhs, and remember this would have been tax free. This 99,000 became 16 lakhs. If it had been put in the Sensex, it would have become 26 lakhs. That would have been a post-tax return of 18% versus slightly less than 15%. A difference of roughly 10 lakhs in the final outcome. More than 10 lakhs, because 16 lakhs may say there would have been taxation. The other issue I think that somebody had spoken about, that a flat was bought at 12 lakhs in 2002 and sold for 62 lakhs in 2012. The return on that is roughly 18%. So definitely a great return. But the point is that if they had put that money in the Sensex, the return would have been even higher at 20%. So that tells you that the return typically from equity tends to be much better over long periods of time. The other thing, are the risks involved in real estate. Now, a lot of people tell me there is no risk while investing in real estate. But let's look at some of them. I'm sure when you invest in under construction property, you would be aware of the huge delays that happen in construction. The builder tells you 2 years, builder tells you 3 years, it will be 4 years. I think it's come to a situation where a 1 year or a 2 year delay is considered as having delivered in time. We have all heard of the illegal construction issue that arises in whether it is the Campa Cola or the forest lands in Bombay or Noida. I think even this is after the construction is complete and people have been staying in the houses for 5 or 10 years, 15 years. In the case of Campa Cola, 25 years, and they are now going to be dishoused. And this is a big risk with real estate. Title is always a big risk. Delaying possession is a big risk. It tends to be a large investment. If you invest in this NSEX, you can sell it off, get your money in a couple of days. That's not true of any real estate. There is the risk of encroachment if you are investing in plot. We have a lot of people who are fans of investing in plots. There can be zoning changes that happen, again very much applicable to plots. Your plot was a proper agricultural land. You continuously visit it. When you go to sell it, you realize that some reservation that was on the other plot has been put on your plot. Compulsory acquisition happens. I have known of cases where somebody was safeguarding his plot. It's only when he went to sell that he realized that his plot of land had been compulsorily acquired and that the check for compensation had been returned unpaid, and he had a big problem and he had to file a court case, etc. The point is not that real estate is a bad investment, but like any other investment, people underestimate the risk of real estate. In conclusion, I think let's not say that buying own house for staying is an investment. Buying own house for staying is not an investment. It is a consumption item. Its return are far in excess of the financial return because it imparts a certain amount of stability and security, which gives you a career enhancement impact, and therefore you don't really calculate financial returns when you buy a house for your own stay. But any other real estate investment should be evaluated on financial basis. In the long run, as we have shown from the figures from Bombay, clearly real estate tends to give returns of around 8 to 9% over a 10-year plus period, which is around inflation. So it gives you returns equivalent to inflation. But in the short run, if any of the risk does not materialize, it tends to protect capital value. Unlike a share which over short periods might see a plus or a minus, but over long periods it always gives better returns. In real estate, except for 1 or 2 periods in the short run, it tends to protect the value. It doesn't tend to give you negative returns. But the risk is that because of the inherent risk of real estate, in few of the cases it can actually wipe out your entire investment. If the title is not proper, if the project is abandoned by the builder, if encroachment happens on your land, then your entire capital or a substantial portion of your capital can get wiped out. All this does not mean that real estate is a bad investment. Only it means that people with very large portfolios should consider real estate as one of their investment items. And as I repeat, buying own house for purpose of staying is not an investment. That is something I think everybody should do. Once he has made a commitment to a city, he knows that this is a city in which I am going to stay for the next 3 or 5 years, and he has the money for the down payment. At that point of time, I think people should buy a house for their own stay. They should not do all this rent versus buy. That is my personal opinion, because I think having your own roof over your own head, even though with borrowed funds, as long as it is a reasonable and in line with your income, is something that everybody should have. It imparts a stability and security that has a lot of career enhancement impact. And even when you make an investment, I would say please buy ready to move in property to reduce risks. With that, I am at the end of today's webinar, and if there are any questions, I would be happy to take them up. Let me see if there are any questions. Okay. What if I buy an under construction property from a reputed builder which will be ready in the next 2 years and sell after it is ready? Will it be good investment for shorter duration? I think in real estate there are two issues with shorter duration. One, very very clearly, the transaction costs are high. When you buy under construction, you will be paying close to 14% as service tax and VAT, etc. You carry the risk that the project will be delayed. Even capital gains, there is an issue that if you don't hold on to the property for 3 years after it is ready, then it will be treated as short term. So I don't think it is a great idea to invest in an under construction property for the purpose of short term and as an investment. I am assuming you are looking at it as an investment and not as a place to stay. If at all you have a large portfolio and you want to have a certain amount of real estate, I would suggest look at ready to buy property so that your risks are contained, and if you hold on to that for 3 or 5 years, the transaction costs will get amortized and you may also get a little bit of revenue as rent. But buying under construction property for the purpose of investment is not a great idea. Tanya has a question. She has raised her hand. I am unmuting you, Tanya. Please go ahead and ask your question.
Yes, in the last point you mentioned that go in for a ready to move in property. But once we have a flat, now I want to invest in another flat. And nowadays builders are offering these 20, 80, 25, 75% schemes. So which gives us some respite. So it is advisable to go for these schemes.
So I think
Hello?
RBI has...
Hello?
RBI has already come. Your question, Tanya, was that should you go in for under construction flat because of the availability of 20, 80, 25, 75? That really was the question. I would urge you to be extremely careful. First of all, this is not a scheme that the regulator likes. Most of the 25, 75 or 20, 80 schemes are such that you just get, it is a tripartite agreement between you, the builder and the bank, whereby for the fixed period, for some 2 years, the interest on the installments will be paid by the builder to the bank. What you don't know is that if the builder does not pay, then you are liable to pay. And for any reason, if you don't pay, it is your credit report that will be affected. You all, I assume, are aware of the importance of maintaining a good credit history. So very, very clearly, it is not something 2080 scheme. There are some very, very few 2080 or 2575 schemes, which I would call the true 2585 schemes, where you pay the upfront payment and then you have no liability whatsoever by documentation unless the builder is able to give you the possession, and the liability is directly between the builder and the bank. And in some cases you may not even take a loan, it is only between you and the builder. You pay 25%, at the time of possession the builder can demand 75%, otherwise he cannot demand, and at that time you may decide to take a loan. If you are getting a scheme like that, and there are some schemes available, and the builder is very reputed, you may look at it. Otherwise, I think you should completely avoid it. Okay, are there any other questions? Okay, thank you. Thanks, Tanya. Thank you, everyone, for making this a very interactive session. In conclusion, as I said, real estate is not a bad investment, but it is not as great as people think it is, and it is only for people who have large investment portfolios and only for a portion of that. Thank you and bye-bye. Stop this.